Holy crap, history was made this weekend, and it's actually insanely bullish for markets. As there are growing calls for a correction, what happened this weekend could push back on that, which could be good for the bulls. Former President Donald Trump was shot during one of his rallies in Pennsylvania with another crowd member, which was unfortunately killed, and 2 others that were wounded. Last time a president that was shot and injured and lived was Ronald Reagan in 1981, and these were the election results in 1984. It was a total landslide victory. Donald Trump's odds have went up about 7% from 60% to 67% following this shooting over the weekend. And this is actually positive for markets, because from the market's perspective, what a possible Trump presidency could mean is lower rates, number one, that's positive, but lower rates also means lower odds of a recession, or at the bare minimum, a deep recession. This also could potentially mean a more fiscally responsible federal government. In other words, maybe less government spending. And this could really help in pushing down your 10-year treasury yield, which is really the main borrowing tool for mortgages, for auto loans. It's the 10-year treasury yield. So if the 10-year treasury yield goes down, that means higher valuations for stocks. You have now seen many individuals in the investment community endorse Trump or go along with this, narrative of what happened with Ronald Reagan, which is basically Trump is guaranteed gonna win, including Grant Cardone that says this determined the outcome of the 2024 election, Peter Schiff that is endorsing Donald Trump, Elon Musk that says he fully endorses Donald Trump and hopes for his rapid recovery, Ryan Cohen of GME that posted Trump 2024 on his X account, Tom Nash that says Trump 2024, don't like it, unfollow, Stephanie Link from CNBC that says Trump just won, Bill Ackman that endorses Trump for president. I mean, the list goes on and on and on. And as the markets are a tool that prices things in ahead of time, this could actually be good news for stocks in the, near-term future. Now, futures markets are yet to open, but I imagine we're probably going to be in the green, although you could say this could raise the odds that Biden drops out. And if Biden were to drop out, there would be uncertainty who would step up, presumably Kamala Harris, and that could cause overall more uncertainty, which could be a negative if that scenario were to happen. So I would say the markets just got a big win for the bulls. Although there are many on Wall Street that are calling for a 10% correction. Seth Golden says remains very improbable that a full 10% correction occurs in 2024 through February of 2025. Piper Sandler's Johnson says, quote, the melt up in the S&P and the NASDAQ was undermined by a significant deterioration in breadth, leading us to believe that SPX, the S&P 500, is overdue for a 10% correction towards its 200-day moving average off of the 2022 lows, too early to rush into sustainable rotation camp. And the actual note says Piper Sandler is raising concerns of a market correction in the coming months, warning that now is a time when fools rush into the market. Despite Thursday's rotation into interest rate sensitive sectors such as regional banks, home builders, and solar stocks, the firm says there is not yet enough technical evidence to indicate that the broader market participation can be sustained. Which, this is what a lot of people on Wall Street, specifically big money, have been saying is this rally we've seen in the equal weight S&P and the Russell 2000 hitting the highest levels we have seen, well, new all-time highs for the equal weighted S&P, but the highest levels we have seen for IWM since January of 2022, a lot of big money is saying that was just a tactical short squeeze because the trade was long Mag 7, short equal weight, or long mag 7, short IWM, and the CPI report came in at a 6 sigma event, meaning nobody expected the super low CPI rating we had. So there wasn't a lot of, adverse hedging, right? People were kind of just going with the same style because they figured, hey, what's the worst that happens here? Maybe Russell outperforms a little bit, right? Maybe we go down a little bit on our, Russell short long mag 7, but nobody was really expecting the mag 7 would get washed out and the Russell would outperform. There was a 5.5% spread between the Russell and the S&P, and it was even larger for the NASDAQ. So what happens when that kind of event takes place is you see markets correct themselves. You see some short covering in IWM, you see a little bit of selling in your Mag 7 to get more neutral. And that's what happened. It's really yet to be seen if this is a material rotation that can continue and interest rate sensitives are going to continue to outperform. I would say from a market investor perspective, it's a little too early to say interest rate sensitives can just be off to the races because we just don't know how much the economy is going to weaken. Because let's face it, it doesn't matter if we get one rate cut next year or 10. If the economy weakens into a recession, that's going to be bad for interest rate sensitives. That's going to be bad for everything. But specifically, the areas that have seen the rally in the last couple of days would be hurt. And it's too early to know how much pain the economy is going to go into. That's why potentially a continued rotation may be a hard pill for a lot of people to swallow. But I do think we were way off sides here with the S&P outperforming the Russell by one of the largest margins in history. That probably should not have happened in the first place. You probably shouldn't have seen the S&P outperforming by 17% compared to the Russell. Perhaps 10% or 5% would have made a little bit more sense. And after the last couple of days, you're more, I guess you'd call normal, something we would maybe expect. So do I think you have to give those gains back? No. But do I think this rotation is going to just continue off to the races? Probably not. A little bit of consolidation at the bare minimum is to be expected, but don't be surprised if we do head into a correction. I just want to put this out on the record. Corrections are healthy, they are normal, they are important for bull markets. This is a bull market until the economy weakens too much. Until there is a recession, this is a bull market. But you need corrections in a bull market to continue to allow that bull market to get stronger. In other words, you don't want a bull market that just continues to run. That's where you get into bubble-like territory. And according to Apollo, the quote, the current AI bubble is bigger than the 1990s tech bubble. And they're comparing this. If you look at the 12-month forward PE of the top 10 stocks, you're back higher than where you were in 2020, and you're way higher than 2000. If you exclude the top 10, you're still higher than 2000. You're not as high as 2020, but you're higher than 2000. And the S&P overall is higher than 2000. And I do think from my perspective, the biggest risk that we have right now is earnings coming up. And this week, it's all going to be about AI. So this is a lineup of the earnings we have this week. You have banks on Monday. You have majority banks on Tuesday. Other names like JB Hunt and Interactive Brokers, Tuesday and after hours. But the AI aspect of this week's earnings kicks off Wednesday pre-market. You have ASML that reports. If ASML has bad earnings or misses in certain metrics, the markets are going to look at that in a very unfavorable way for your entire AI trade that is still very much embedded in your GPU makers, in your hyperscalers, your Mag 7. It's still a large chunk of the valuation in our markets. So any hiccup here with ASML or TSMC Thursday pre-market is going to be bad news for basically the entire market. Now, with that said, you also have Discover that reports Wednesday after hours, and you have American Express that reports Friday pre-market. That can be important for the economy and judging how strong the consumer is. You also have Netflix Thursday after hours. Netflix typically causes a big sympathy move with your other Mag 7s, your software, your technology stocks. So if Netflix does well, I would expect Thursday is going to be a really good day. Or, well, Friday, technically, because after hours, it would, transpire after hours Thursday. Friday would be a very strong day. But I think the biggest one of this week is ASML and TSMC. Because it seems like everyone on Wall Street is waiting for this inventory correction, this buildup of GPUs, this buildup of AI hardware that is not giving any returns right now. This is basically like throwing money in a fireplace. If you're Google, if you're Microsoft, if you're, all of these Mag 7 names that continue to plow billions into AI, there is no return on investment. And Wall Street wants to start seeing a return on investment. So if you start to see that slow down, that investment slow down, that could cause a little bit of a consolidation, if you will, in your AI stocks. Now, we've seen strong AI earnings for 5 or 6 quarters in a row. So is that a base case? No. But the longer we go, the more earnings we go without a bad earnings or without earnings massively impressing investors, you start running a higher risk of that happening. You start running a higher risk of a little bit of a disappointment. So yes, the risk of a disappointment around AI earnings are higher this quarter than they were last quarter, and higher this quarter than they were the quarter before that, so on and so forth. Now, one of the biggest events this week is a speech from Fed Jerome Powell at about 12:30 in the afternoon coming tomorrow. So you don't have to wait long at all. You're going to have a big catalyst coming tomorrow. Now, Fed Jerome Powell's speech tomorrow could open up possibly the door for the cut July 31st. If the Fed wants to do that, this is basically Powell's last chance to do it. Now, markets are only assigning a 6.2% chance of a cut coming July 31st and a 90.3% chance of a cut coming September 18th. So Powell either tomorrow is going to want to signal that first cut coming in July, or he's going to want to signal, strongly that cut coming in September. If Powell gets on and says, yeah, last month's CPI was good, but we're going to need some more evidence, then maybe that could be seen as perhaps the Fed doesn't want to cut in September, but we'll have to wait and see. And check this out. So the markets are pricing in a cut September 18th. They're pricing in a cut November 7th. They're also pricing in a cut for December 18th. So if we look at the Fed Funds Futures contract for December 18th, there is a 50.6% chance of 3 cuts by December 18th. That there could be a mix here. There could be a cut September, November, December. There could be a cut September. There could be double cut in December. Just 3 cuts by December is what the markets are currently expecting. There's a 40.5% chance of 2 cuts by December. That could be a cut September. That could be a cut December. So you're actually pricing in 3 cuts by the end of this year. Now, the form and fashion of how we get those will be kind of extrapolated by what Powell says tomorrow morning. Now, it's not just Powell that is in focus tomorrow. You also have retail sales Tuesday at 8:30 in the morning. We're expecting 0% on a month-over-month basis, but a lot of estimates on Wall Street are actually negative. This will be the next update we also have to the Atlanta Fed GDP Now tracker, because retail sales are 2/3 of the economy, consumers spending money. If that number comes in really bad, GDP estimates could plummet. And some individuals like David Rosenberg and others are actually saying GDP could actually be negative this quarter if retail sales come in bad. So that's another big data point to be watching for. On Wednesday, you have building permits. More building means likely lower housing inflation, and that's overall good for markets. Now, spread throughout this week, I'm not going to go through each and every single one of them. Pull this up for yourself on your phone or your computer, tradingeconomics.com/calendar. You'll see a ton of Fed speakers throughout this week. And, if Powell does open up that door for a cut July 31st, I don't think it's likely. I think it's possible, but not likely. Then you will see these other Fed speakers kind of conform around that idea as well. It's called jawboning, and that's what the Fed does to get the markets ready for what they're about to do. Now, on Thursday, you are going to have initial jobless claims, Philadelphia Fed Manufacturing Index, continuing jobless claims, Philly Fed Business Conditions, CapEx Index, employment, new orders, and prices paid. You also have an ECB press conference that will take place Thursday. All of those events will be important. And then on Friday, just a couple of Fed speakers, but overall, it's going to be a pretty quote-unquote chill day. It really depends what happens with TSMC and Netflix that report Thursday. That's going to be the main story of what moves markets coming on Friday. Also worth kind of keeping your eye on is the 10 and 2 year yield curve inversion. Now, you've started to uninvert recently because you were inverted about 47 basis points, and now you're only inverted 27 basis points. So you have actually started to see a pretty rapid uninversion, and that's typically when pain in markets starts, is when you actually uninvert. That's when you tend to be close to a recession. That's when you tend to get the pain. Now, if you want to know how this works on kind of a more tactical basis, it's because when you start to uninvert, that's the market's pricing in rate cuts. Now, the Fed typically cuts before recessions, or cuts when the economy gets worse, cuts when the markets get worse. So that's why there is this correlation between the yield curve uninverting and recessions and or pain in the markets. You can even see this back in, September to October of 2023. You got a 10% correction during that period in time, and that is the last time the yield curve really started to uninvert. Yeah, this was a 10% correction, and then that led into the rally we have seen up until now. I do think overall, this sell-off on Friday was a little concerning as well. You did see big tech take it on the chin. You've seen equal weight. You've seen Russell. Everything kind of sold off aggressively in this last 30 minutes of trading. This was volatility we have not seen in a long time. When you see selling like this on a Friday, it could potentially mean next week could also be a little bit more volatile. Now, again, we are heading into one of the worst 2-week periods of the year. So the first 2 weeks in July are historically the best, number one, 2-week period for any year. But the second half of July tends to be one of the worst periods for any year. And then August tends to be, a pretty choppy month as well. And with the election coming up, I know there's good and bad associated with that. We all know October, September tend to be pretty rough months during an election year. So it wouldn't surprise me if markets price that in ahead of time. And actually August could be when you get that election correction. Now take a listen to this clip from Ryan Dietrich. We cite him a lot here on the channel, so I want to give him his time to kind of explain inflation, the Russell, and how you could actually see a continued rally from here.
If I hear the word rotation one more time, I'm going to rotate right out of my mind, Ryan, because I guess there's two ways to look at it, right? Either they're going to steal the money from NVIDIA, and NVIDIA's dead, and small caps, long-live small caps, or everything goes up.
Right. And that's the question. Is it like yesterday where that exactly happened, right? Yesterday was a Six Sigma event, which is supposed to happen like every 500 million days. Well, it happened yesterday. Congratulations. Or today where a lot of things were up today, but small caps and some of those cyclical areas led. Solely, we think it's going to be today, door number 2, where just a lot of things will continue to go higher, but on a relative basis, maybe a little money flows out of, communications and technology. They still probably go up. We just think there's more opportunity with some of these other areas that are underloved, underappreciated, and honestly underowned as well.
What in particular?
Yeah, well, let's start with small and mid. I mean, what we talking about, small and mid. I mean, historically, on a relative basis, small caps are like as cheap to large caps since 1999. Now, just because something's cheap, I've done this a long time. So have you. How long have we heard EM is cheap? It keeps going down. You need a catalyst. And again, we think a strong economy the rest of this year, which some people are kind of doubting that. We're not yet. And again, the likelihood that the Fed's going to cut a couple times real quickly. I know we don't have a ton of time here. You look at CPI X shelter the last 3 months, it's negative on an annualized basis. X shelter 1.8% the last year. inflation is last year's problem solely. We think, 2 to maybe even 3 cuts with an economy that's still growing is going to be a backdrop for small and mid.
And that's the key. An economy that continues to grow. That's why this market is a bull market. No matter if we get a 10 or 15% correction, I will still sit here and say this is a bull market until the economy gets worse, until the economy starts to throw out more of those recession questions to institutional investors. Let me put it this way. Until big money starts to say in more masses, we may be going into recession, this is a bull market. You're not getting enough recession calls right now to say we're even close to a bear market. So things could obviously change quickly. The retail sales data will be important coming this Tuesday. But I do want each and every single one of you guys to be prepared for a potential correction. That's healthy. It should happen. And honestly, you want it to happen. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.